And hi, I'm joined today. My name's Dan. This is Jesse. We're the institutional sales team over at MaiCoin. We're joined today by a very special guest, a friend of ours, Pankaj Balani from Delta Exchange, a futures derivatives platform that set up last year. And today we're going to ask Pankaj a few questions to try and hopefully open up the world of derivatives to our users and let people get a sense of what's going on under the hood.
Maybe apologies in advance for any sounds. This is the MaiCoin headquarters, which is currently still under construction. So if you hear any strange sounds, that's what it is.
This is our retail store. So it's the first ever retail store for crypto in Taiwan. It'll be opening at the end of July. We're all very excited about the big opening. But there'll be more details on that on the platform over the next few weeks.
Thanks, guys. Thanks for having me over.
Thank you for joining.
Yeah, pleasure to be here.
Yeah, Jesse, do you want to?
Yeah, so question number one, Dan and I previously worked together at investment banks. I know your background also is from investment banks. So can you share with us briefly how you got into the space and what attracted you to Bitcoin, digital assets, and cryptocurrency trading?
For sure. So for us, actually, it's a 3-member team amongst the founders. We're 3 co-founders, and our tech co-founder, Saurabh, it was him who got started on Ethereum. And he was really excited by the platform and Ethereum platform and what it could do. And when we started to look at it, we were like, wow, this is really powerful. There are so many things that you can achieve by using smart contracts. And that was our induction into cryptos. And this was back in 2017, early 2017. And when we looked at the space more closely, we found that, look, to become a real asset class, which is more where cryptos is going, that it's becoming it's establishing its own financial system, and for any financial system to be complete, you need a strong derivatives play. You need a place where people can come and hedge their risk. You need a place where people can protect themselves against any kind of moves, and that is when we realized, coming from investment banking and a derivatives background, I had seen this. My co-founders had seen this, so we realized that yes, there's an opportunity here. There's an opportunity to build strong derivatives house that can provide investors with all these kind of all this flexibility, and in turn help the ecosystem grow. We are firm believers that derivatives aid to the building of ecosystem, and we look at ourselves trying to build that arm which helps the crypto ecosystem become bigger.
So I guess there's probably hundreds of spot exchanges that we could mention now, when you would think about derivatives, there are really only a handful that have got to any scale so far. So can you give us just a bit of sense to our users of the Delta platform? Does it have any unique attributes? And I guess that would pertain to sort of your strategy and how you think about sort of building in this environment.
Sure. So derivatives is new in cryptos. It's still pretty niche, and there are houses that are doing few things. Not everyone is doing everything, and there is a lot to be done. So, for example, the major player in this space, in our space, is BitMEX. They are champions when it comes to Bitcoin leverage products. Most of their volumes, if you see, are coming from Bitcoin perpetual swaps, which is basically you can call it a self-rolling, perpetual future. But yeah,
just what kind of volume is that? Just for
they do about over $2 billion on a daily basis in trading. Wow. It's pretty big, but when it comes to scale on derivatives, it's pretty small.
So it's actually bigger than any other spot exchange volume.
Yes.
Yeah.
But spot exchange volumes are always eventually much smaller than derivatives volumes. Right. We can come to that later, but $2 billion in the bigger scheme of things where we think this is going to be, it's pretty small.
Right.
We think in 5 years' time, 2 billion, this is going to be $100 to $150 billion scheme.
Right.
Just the futures on cryptos. And I say the futures and options on cryptos, not just Bitcoin. So every player is going after building something, and BitMEX is doing a fine job on building the Bitcoin perpetual product and the leverage product on the Delta 1 kind of product on Bitcoin. Deribit is focusing on options, on Bitcoin options, Ethereum options. Then there are other houses catering to other things. We are focusing more on altcoin futures, and that is where we are different. We are the only platform globally to offer futures on about 15 altcoins and names that are not listed anywhere, not on BitMEX, not on Deribit, not on any other derivatives exchange. So we were the first ones to come up with BNB futures.
Yep.
We are the only ones to offer futures on Leo, which is a coin by Bitfinex.
Oh, yeah.
Just 1 week after the launch of Leo, we launched Leo futures, and there's been a huge interest in those. We have futures on Atom, BAT, Tezos, RVM, and yeah, that's how we are different. That's the strategy, and that is why customers come to us. So yeah, most of our customers, we've been very lucky to have a very loyal set of customers and customers that actually help us acquire more, and most of our audience comes from word of mouth.
Right.
So, speaking of BitMEX, one of the key things that the regulators are concerned about is, investor protection, right? And people often dismiss the whole industry as, heavily focused on speculation. BitMEX, famously or infamously, provides, 100x leverage, which I think something certainly domestic regulators aren't familiar or probably not comfortable with. So that really kind of adds to the reputation I think that crypto has as, being a very speculative focused investment. So what would your reaction be to that? Like, how would you push back and tell people what are the real uses for derivatives other than just strapping on some 100x leverage?
So, like most of these things, right, 100x is a headline number.
Yeah.
Eventually, there are very few people who end up using that.
Yeah.
And there are folks who use 100x leverage, but these are very seasoned people. They know what they're doing.
Yeah.
And what they actually want to do is make money off small moves. They don't hold 100x position for a longer time.
Yeah.
Because
I think BitMEX were, when they released their April data, they said
yes,
it's like 30-something times average for short positions and 17 times for long, I think it was.
I think 7.
In April. Oh, I thought it was 17.
Yeah, so usually if you look at how derivatives have evolved in other markets and equities, and you would realize that leverage tends to be between about 5 and 20.
Yeah, maybe the weighted average is lower than the average per trade. Because I think they probably released the data on the number of trades, the average rather than the weighted average, because the weighted average would be much lower.
Much lower.
Yeah.
So the point I was trying to make is that yes, there is 100x leverage, but that's just headline. There's very few people using it. There are few scalpers who want to make good money on the $3 up move, $3 down move. These are people who are doing it professionally and all day long. So for them it makes sense. Yeah. Not a lot of people end up using it. Using 100x, most people tend to gravitate towards somewhere between 5 and 10. Yeah. Even lower at times if you have a bigger position, like 3 or 4. And those are healthy levels of leverage. And look, there is speculation, yes, but at the other end, you have to see it's a two-sided market, right? If there is a buyer, there is a seller. If the prices are going up, yes, people are speculating, and when they are buying, but there is someone who's selling. And a healthy market is always one which is able to cross the demand which is able to cross demand and supply. Yeah. So if there's buyers, there's sellers, and there should be a natural need for selling. So where does this natural need come from? This need comes from hedging and market making and arbitrage. Mainly hedging, that's the original need. So,
well, it's similar to shorting, right? It provides liquidity and creates a healthier market because there's more depth and participants with different points of view on the market.
Yes, but let's take an example. So let's say you are a miner, you're generating Bitcoin, right? Yeah. Every day you're generating Bitcoin. Yeah. You are exposed to the price risk of Bitcoin. Yeah. Every time your supply is or your generation is like fixed. Yeah. But your demand is variable and it changes. The price at which you are able to sell the supply that you're generating varies. Yeah. You want to be able to lock that. Yeah. Right. So that is where derivatives come in. So these guys become the natural sellers. Any miner would want to reduce the volatility in their final sale price. Yeah. And so if the price is good, they would look to short some futures.
Just as an oil producer would.
Absolutely. Yeah. Just as any commodity market, just as any food grain market, any oil or other commodity market, there's a natural demand for those. Yeah. Where else can the demand come from? Let's say you are a crypto fund, a big crypto fund, you have exposure to a lot of assets. Yeah. Your market has run up and you were looking to lock profits on some of your positions to reduce the volatility in returns of your end investors. It's important because otherwise your portfolio is going to look like this. Yeah. And your investors are not going to be very happy about it. So if you want to make investment in crypto a serious industry, derivatives are inevitable, because I, as a big portfolio manager, cannot have $100 million to $1 billion How do I manage that? How do I control the price volatility in those? I'll have to go and sell and then buy back again. And coming from investment banking background, we know that that can huge incur costs and time.
Yeah.
You can miss out. So it's best to use derivatives and kind of create a short position when you think that the market is overheated, or you think it's a good price for you to lock some profits.
And that's common in traditional markets as well. But the other part that I think is unique to our market is the difficulties engaging with fiat banking, right? So, famously the ICO bubble of 2017, 2018, those projects raised, a ton of money.
Yes.
They couldn't put it in the bank because they weren't able to as crypto companies.
Great point.
And then, Ethereum starts to go down. All of a sudden you raised, 10 million. Now you have 5, you're getting kind of nervous. Your investors are calling you. And you should have.
Yes. So think of it. You have a great idea. You spend a lot of time and energy in raising a ton of capital, and now you want to build something. But because everybody around you has done the same thing, when the price market starts to look weak, everybody sells. And when everybody sells, price goes down further. So it's a race on who can sell faster. And that's why you saw Ethereum going down from once it broke a certain
or whatever to
$90, right? And once it broke a certain psychological level, it was like, oh my God, I want to be faster than others. And that's bad, because you put so much time and energy in raising this capital, right?
Yeah.
And forget about doing the real work. Right now, you're worried about how to protect the capital. If there is a place where you can go and short futures on Ethereum and lock a dollar rate on it, that is very interesting, because then you can short the future and not be worried about price moves at all. Every company, like every listed company, will have a treasury department that does just this, that they manage the. So if you're a big company that is dealing in multiple currencies, you have Australian dollar, you have Taiwan dollar, you have Chinese yuan, you have US dollar, you have so many risks. All of these are fluctuating. You have to control. So everyone, it's very common in traditional markets, and I think every crypto company is going to have a treasury arm too, where they're going to manage their money and reduce the volatility in their money. Actually, if you go and read on blogs of some of these websites, you can find that they have acknowledged that, look, we did not do our treasury management.
It's almost not their fault, because you almost couldn't.
You couldn't. Even today, the products that are available for treasury management, like for Ethereum shorting, are not 100% the best products. I mean, I won't go and name anything, but there are products which will just convert your risk from one crypto asset to another crypto asset, or there are products that will not give you a perfect hedge against dollar. So that is another thing we are focusing on, that how do we have a product design that is not only good for speculators but also very good for hedgers and market makers.
There was a PwC report out, I think it was last week maybe, maybe 2 weeks ago, and it was saying that only, they said that I think something like there's only 150 serious hedge funds playing in the space right now, which is low, and they said that only 30-something% of those were actually had an ability under their mandate to short, which struck me as a low number, because I would have thought that an asset class that has cycles that often endure very, very deep down markets. That just being a long portfolio in crypto is a very painful experience, and really the way to make serious money is to maintain your capital in the down market, so that the base is so much higher, right? So rather than it being down 80% and then having 100 times off that number, you can keep the peak of your previous cycle, or maybe even make some money. Why do you think it's such a low number of funds that are in the space right now who are actually doing any shorting or?
So I think there will be more than that, to be honest.
It sounds like a low number, doesn't it?
It sounds like a very low number. Like, 30 is like, we'd have more than that. But the broader point that it's still not very crowded, which is a good and a bad thing, because there's a lot of opportunity. So we in cryptos we talk about this all day long, that there are so many arbitrage opportunities, there are so many trading opportunities, that you can pretty much make a lot of risk-free money. If you have been active in equity markets, you would look at these markets and see, there's good opportunity to come here and make money. So to the original point about there are less funds, that's the evolution of asset class, right? like any other asset class, there are some people who get interested, then price moves higher, then more people get interested, then price moves lower, people get fall out, and then the next wave starts when more people join. We've seen 2-3 cycles already. I think we are going to see more every 2-3 years. We are going to have a cycle, and it's very common in other asset classes. It will happen here as well. And as we grow, every bull cycle we'll add more and more.
Yeah.
So in last bull cycle, I think it was the first time that crypto hedge funds were coming, right?
Yeah,
Earlier
towards the
it
end.
was,
Yeah.
Towards the end, that was the first
Great
time.
timing.
Yeah.
Yes, we had talk of institutional money coming.
A lot of
in.
launches in Q4
Yes.
of 2017.
Yeah.
Yeah. So yes, that was a bad time to launch, but yeah.
So this institutional sort of promise, we're always talking about.
Yes.
That's you just mentioned it, saying in each cycle we get a few more in terms of institutional clients. So this cycle, let's just say that this cycle has another 3 years in the upswing. Who knows? But let's make a wild prediction.
Yeah.
And if it was 3 years, do you think that's long enough for this cycle to be the actual institutional driven cycle, or you think this is still most likely this cycle is still very much dominated by retail, similar to say the last cycle from 2015 to 17?
So I think in the last cycle, towards the end, like we were saying, there was a lot of institutional interest that were starting to come in. And what has happened is that in this bear market, there's been a lot of work that has been put in. So a lot of people have actually built the infrastructure that is needed for the next run and for the institutional money to come in, right? There's more needed, but at least it's more than that what we had previously.
Yeah.
So bear markets are always a great time to put your head down and work.
Yeah.
Right.
You can't really do anything else. You don't have a choice.
Yeah. And bull markets are so frantic, right? Because you don't really get time.
Yeah, there's more stressful, really.
Yeah. It's so busy.
Yeah.
So.
It's weird. It's the only asset class where, for some reason I'm sometimes smiling more when it's going down than it is going up, because it just stresses me out. I don't know why. When it goes up 10, I'm like, oh no, here we go again. It's going up. When it's down, I'm like,
Yeah. So anyways, what was I saying? Yes, there's been a lot of work that has been put in, which because when you have serious money coming in, it also needs to have it also comes with serious constraints. Like they need to protect the capital, so a good and a sound derivative infra or ecosystem needs to be in place. So places like Deribit for options, places like BitMEX for Bitcoin futures, places like Delta Exchange for altcoin, hedging your altcoin exposure. These are needed for good quality institutional money for the points we just discussed.
Yeah.
Then you need strong custodial solutions. A lot of them have started to come up. You need some activity and clearing. That is, I've seen signs of that starting. So I think the next run is going to have more institutional money than the previous one, of course. And every time you have more serious money coming in, your cycle length tends to be longer because this money is sticky.
Yeah.
So, and it's one of those things. Some institutional money comes in, then some more comes in because they see that, okay, this money is done fine. This other fund manager has been doing okay. So let us also allocate some part of our asset to cryptos, and that builds more and more legitimacy for the asset class. So overall, I think it's going to be like a snowball effect. And I think it's going to elongate the length of cycles.
Well, institutional money is also like very herdish too.
Yeah, it is indeed.
So as soon as you get a couple of like Fidelity is huge.
Yes.
Once their business is up and running and it goes well and they make profit, everybody's gonna.
Everyone gets the FOMO.
Yes,
that's right. So they get FOMO as well.
Yes. Yeah. So reality is, if one of those big names comes in and does well, then you'll see entire world just coming.
Yeah.
But the thing is that how do you get one big name to come into the asset class, and because that doesn't happen. There's a lot of if things go wrong, there's a lot of explaining that needs to be done.
Yeah.
So before that, they'll probably have a few small funds, and they also know this, so they'll probably send a few vehicles.
Yeah.
Like, okay, this is a special vehicle for crypto. Let's see how this performs before we move in with more serious kind of capital. From what we hear and talk to funds from our institutional background and others in crypto now, I think 2021 is when a lot of players they've already started to look at it. It's not like they feel that they're missing out at this point in time. They think that they can wait.
If you're like, kind of the most nimble institutional money, like mainstream institutional money, you're like a large multi-billion-dollar hedge fund.
Yeah.
If you decide tomorrow that you're going to do a digital asset fund, like that's not going to happen in the next probably quarter, right? Like that's going to take 2.5, 3 quarters.
It's like 30 days of 90 days of just compliance and paperwork. So there's decision making, then there is compliance and buy-ins and paperwork, and then there's money, and then there is investment. So it's a 6-month cycle in itself, from the point that you started to believe to the point that you could act with this capital. I mean, and that's why retail is so fast, because it's their capital. They don't have to do any explaining or
family offices.
Family offices. That's why, in the evolution you have a lot of personal money that comes in, big personal money. Then you have family offices that come in. Then you have hedge fund money that comes in. Then you have more traditional money that comes in. And towards the end, you have the huge checks of insurance companies that come. That is like pretty big.
So, I mean, we all came from an institutional background. So, some of our, when I think about the size of crypto, it's what, 250 billion roughly now.
262.
Before the interview, just before the interview.
Let me check my portfolio.
And some of the clients that we used to speak to manage more money than that.
Yes,
so
absolutely.
They manage more money, in some cases, multiple times more money at single asset managers. So I often have thought about the idea, you've over the last few days that we've spent together, you've talked a lot about how much free money there is on the table in terms of lots of opportunities, arbitrage.
Yes.
But realistically, do you have any sense of how much money would it take to come in right now and close those opportunities down, given the size of the asset class? Like, if somebody came in with $1 billion fund that was looking to arbitrage futures, across different platforms, is $1 billion too much right now, or given $1 billion that had leverage? Like, actually, how big an ecosystem can we support right now with such a small asset
another
class?
tag on to Dan's question would be, how come these guys aren't doing it? Like, I see your tweets go out from Delta, and I look on your analytics stuff, which is really good, by the way. And it was talking about 100 bip spreads on across Deribit or BitMEX versus Delta. Why are these spreads there? Like, how come the big traditional guys aren't coming in and closing these? If the guys in crypto aren't sophisticated or fast enough to do it, how come the traditional guys aren't doing
So
that?
maybe it's because the asset class is too small for it to matter. Because of course, if you're running 200 billion, what's the point of investing in an asset class? I mean, that's one argument. I can still see a reason why they should do something, but what do you?
So there is a lot of money to be made in arbitrages in crypto, and on the crypto side, there was a lot of money on the arbitrages by arbing coins between exchanges, right? Like buying coin on exchange which is cheaper and then selling it as at exchange which is expensive. And there's geographic arbitrage, but that's difficult to close because of regulatory reasons. So let's leave that aside. But even otherwise, there was arbitrage. Now that has started to close in because participants have become sophisticated. So derivatives on cryptos have started 2 years back, more seriously, or 1.5. There was BitMEX and did a great job, and there was Derivit as well. But it became more mainstream only in 12 to 18 months. And that is why these opportunities still exist, because a lot of players are still not looking at it. And as more and more players will come in and they'll look at it, these opportunities will close. And then there'll be the $1 billion checks who will say, there's a great opportunity. I'm going to take my $1 billion and try and absorb this all. And I think at current state, what the size of markets is, $1 billion is good enough to absorb and close all these opportunities. Because you can lever it up a little bit as well.
That's what I was thinking. So it's not really that big an opportunity. But
the point is, as more money comes in, more of the opportunity also increases. So the rate at which the opportunity closes is of course faster than the rate at which money can be absorbed in the markets. I think it's not like you can close the opportunity once, but it'll open up again, and then it'll take a few iterations because of when all these arbs and all these things wipe out. In equity market, it can, if I look at example of India, it took good 7 years for futures arbitrages to disappear. And if you have leveraged ETF arbitrages in US, and they still exist. So it's whenever there's and why do we have these tweets that highlight that 100 bips found, 200 bips detected? Why do we have that? Because it's the same Bitcoin futures being traded on 3-4 exchanges, and money is sitting on piles. And let's say money is on 3 piles, and one of them starts to act. So the price starts to move up on one exchange faster than another. And that is when you have an arb detected. You can also look at an arb and see that there's a sharp move. the move was started. So yeah, a lot of our customers actually look at arbitrage not just for locking the arbitrage, but also for seeing that market has started to become volatile.
Obviously, the custodial system is a big part of this as well, because
once that comes in, this will go away. You are absolutely.
So you can't put $100 million in, into Delta Exchange. Probably is not going to get through compliance.
Yes.
Right. It has to be with Fidelity or somebody like that. Right.
And cross-exchange custody kind of solutions come in that people can act on multiple exchanges very fast. I mean, whenever there is an opportunity detected, you need to have money on another exchange to be able to act.
Yeah.
Right. And now that people have started to realize that there are opportunities, what they'll do is they'll put money on all three exchanges. But there's often a case when you get tapped out of how much capital you have, and you need more, and it takes time to bring in.
Yeah. Like something you said just made me think of something else, which is, a lot of this is kind of a sometimes in the mainstream press, people in crypto who are in crypto, the retail, will say, institutional money is the dumb money this time because they're the ones coming in later. And they always say, you often hear people say, oh, but once Bitcoin goes above this price, you'll see institutions come in, and they often refer to it, being price dependent. But I think thinking about it now, what it is it's just the size of the opportunity, right? As in, it's not actually. I mean, it is. You can think of it in price, but what it actually is how big is this whole investable asset class, and can I scale a business?
So one of
it. So it sort of it works both ways.
Yeah, and one of the things that any institutional fund is worried about is exit, right? How fast and how quick can you exit? And if you are not able to exit, then can you hedge? So like I said in the beginning of this conversation, we are building the ecosystem for people to be able to protect themselves.
Yeah.
But think of it this way. Let's say you want to build a $5 billion position on Bitcoin. It's great money. I don't want to be late. I want to come in Bitcoin. $5 billion.
Oh wow.
Let's say you want to build that. It's going to take you 1 day to execute through your
position. Do you
position.
know that, man?
I have a seller. I have a seller.
So when you have very big amount of capital coming in, that's not a big position, right?
Yeah.
Like you were saying, people manage more than $250 billion. $5 billion is not that big. It's pretty big for cryptos now to be able to absorb it. But look, that's where we can go.
Yeah.
So if I want to build $1 billion or a $5 billion position in Bitcoin, I'm really worried about when I'm going to close, how much am I going to move the price by? I can buy in, yes, but when I'm looking to exit, how much price impact will I create myself just to exit?
Yeah.
And that's a big worry. So when you're a big animal, what are you worried about? You're worried about that, look, it's a great opportunity, it's a shiny thing, but is it big enough for me?
Yeah.
I can be slow in acting, and I know that I'll lose out on some. But there's no choice.
So that's kind of like the double-edged sword of the way volume is fractured in Bitcoin, is that we have, it's kind of good, I guess, to have it decentralized across multiple exchanges globally. And you look at that top number, I think it's like, 70 or 80 billion recently, but that's, spread across exchanges. And we saw recently, like on Bitstamp, how a relatively small amount of money
could move the market
at one exchange could like really impact markets, right? So I guess that's another.
I mean, think of it this way: if you have a $20 million position that can create that kind of impact, and it's a fairly small position when you talk about institutional money. Yeah, it's a fairly small.
Yeah, in what is supposed to be, I guess Bitcoin is like whatever $1 billion, 20 billion or something recently.
Yeah. Can you explain the one thing you mentioned the other day was giving an example about what reference price a futures exchange should use for its contracts.
Yeah.
And you give the example of 3 people in a room.
Yes.
Can you just give that example and just explain what the reference price is to people who don't understand that part of it?
Sure. So every futures contract is based off an underlying price, right? Now, so first of all, you have to design an underlying price. Now, whenever you design a futures contract on anything, let's say we are designing a futures on Bitcoin dollar. Now, you need a very good and a healthy price of Bitcoin dollar. So first of all, you start by identifying where is Bitcoin dollar traded, and pure fiat versus Bitcoin. Yep. No proxy of dollar, no stable coin, because you don't know which day your stable coin will become unstable for that moment. And that's a challenge. So what you really want is a pure play, the real extract with Bitcoin against fiat. Give me that rate. So for the step 1 in this is identifying where are these places. Let's say there are 5 exchanges in the US that give us this, Bitcoin dollar pair.
Yep.
Now you want to take exchanges which are relatively sizable in volume. And okay, first of all, they should have good size volume going on. Secondly, they should be comparable. So you don't want to be comparing an exchange that has $10 million of daily traded volume versus an exchange that has $100,000 of daily traded volume, because then you are basically comparing apples and oranges.
Yeah.
Because a $100,000 daily traded volume can print a price which has no significance, right? I can take $200,000 on that exchange and manipulate the price. So you want to have exchanges which are very close to in terms of daily traded size.
Yeah.
And then let's say you find three of these. For example, BitMEX, their underlying was Kraken, Coinbase Pro, and Bitstamp. Now, the bigger challenge you have is, let's say the price on one of them is 4,000 and on the two other of them is 5,000.
Yeah.
How do you know which one is correct? So imagine a situation where you have three people in a room.
Yeah.
Two are saying one thing, and one is saying something else. So
that's normally Jesse.
Yeah. So let's say two of us are saying this bottle is empty, or this bottle is full of water, and Jesse is saying no, this is
empty. I can see with my eyes. Yeah.
No,
so
you would definitely say that's full.
It's a conspiracy. Yeah.
So it only takes one person to change their stance and you to become majority from minority.
Yeah.
And when you are doing everything in real time and systems, so this is called outlier elimination. But to select outliers or to remove outliers, you need to have enough number of data. So if you're looking at 3 data points, you can't tell which one is outlier.
Yeah.
If we are saying that the bottle is full, and if we remove your statement on this, then we've actually we've actually said that the bottle is full of water when it's actually not. So yeah, that's the point that I was making, that it takes a lot to do a proper index design, and I think players like BitMEX, Deribit, they've done a good job, but there are a few things that are left out. For example, outliers should not be used when you have 3 exchanges or 5 exchanges, because you don't know which ones are outliers and which ones are not.
Yeah, the
like
situation
it doesn't account volume, right? Yeah.
It doesn't account
about before. If the one exchange has a lot of volume, it gets whacked.
Yes.
And price goes down significantly, and they just look at price. They're like, "Oh, that's outlier. It moved a lot more than the other ones."
Yes.
But all the volume is traded on that exchange, right?
So that happened with Kraken when Bitcoin was at 5,300, and there was a trade on Kraken for 4,300.
Yeah.
That traded like 1,000 Bitcoin or 1,500 Bitcoins or something. That was a $6 million sell. And most exchanges came out and said that, look, we don't think it's a right price, but the reality is out of the 10 million.
That's what the seller thought after.
Yes, that's what the seller thought.
Oh, shit.
That's not the right price.
That's not the right price.
So yeah, if you have $10 million traded in those 5 minutes, and out of that 6 million came at a price of 4,000, the real price was 4,000. But then where do you mark it? So, and it's important because you should have liquidated some people. You did not, because you removed the price. And index design is a very it's a good topic, and it's very important, and it needs to be done very carefully. We've seen people take Bitcoin dollar price and Bitcoin USDT price and Bitcoin USDC price and just mixing them up, adding them together. You can't add those. No. You can't take average of those, and just taking price averages is also not very good. You should take some kind of weight, and weight should be. So one of the things that we are looking to do is use the last 24-hour traded volume as the weight for that index.
Okay.
So let's say there are 3 exchanges. Each one of these trades $1 million every day. But in last 24 exchange, one of these exchanges has only traded 100,000.
Yeah.
And others have traded $1 million each. So you need to reduce the weight of this exchange, because this is becoming insignificant in the real time.
Yeah.
And if once it becomes significant again, there's 24-hour history, then the weight of it goes up. So it's inspired by the volume weighted average price concept that we use in stock markets a lot to see what was the real impact price. Just that here, instead of using the normal volume, we are using a 24-hour window rolling volume.
Yeah.
And use that as a weight. So we are still building those, and this is one thing that we found to be very promising.
Okay.
Rather than going with a simple price average, because that can lead to situations like BitMEX, where they remove one of the exchanges, and because it was a price average, all you need to do is manipulate one, and then the other one also.
So, I mean, this obviously shows there's a lot more to consider in a derivatives exchange and a spot exchange. And I mean, we've got hundreds of spot exchanges globally. Obviously, Max is the only one to have a luxurious VIP room where you can conveniently open accounts and begin trading.
And talk to your institutional sales team.
Exactly. But that aside, there's not that many derivatives exchange, right? And it's very clearly dominated by one player with not that many products. So why are there so few derivatives exchanges?
Well, I think more of them will come up as the opportunity is opened up. Others are looking at it, and as demand comes in, more of them will come up. But yeah, I think there's a lot that goes into building a derivatives exchange and designing your product properly. So we just spoke about index formation. Then there is health checks on the index.
Yeah.
So if the underlying does not trade for last 10 minutes, are you using the right price to mark the positions?
Yeah.
Ideally you're not, because there's no trade happened. So you should stop the trading on futures and then disrupt markets and restart again. Those kind of procedures, in spot you don't need to build them.
Yeah.
Because you have a buyer, you have a seller, you can trade. But in futures, not only you need to have a trade, you have positions that you need to mark.
Yeah.
Then you have to expire contracts, right? So how do you decide the expiry price? You build a smoothened price so that there's no manipulation possible. Similar things, and this is just futures. When you have swaps, how do you build rates that will be exchanged every 8 hours? For example, there's a difference between the way we do things and BitMEX does things, and slightly how Deribit does things. So in BitMEX, if you have a position at the time the snapshot is taken, you are charged a rate.
Yeah.
Despite the fact that you did not have the position for last 8 hours or not on the perpetual swap contract. And so essentially, right before the rate snapshot, you can close the position, and you can add to the position right after the snapshot. And if there's no impact on the price, if you don't have commission impact, then you can actually save paying the rate. So yes, for us, we see if the position, and Deribit also does the same thing, that if you, for whatever time you've been holding the position, we charge you the rate.
Yeah.
But yeah, you need to build these things, and you need to understand them very closely. You need to build them differently, and then there is options, which is again going to, bring these kind of things. So volatility, which is mass volatility.
There's just not a lot of people that, number one, understand these things, number two, can build them, and number three, can build them at scale, right?
Yes. So this is just the financial product side of things. Then you need to build risk engines that check risk of positions every second. So we have like 15 pairs, right? People can have position 5, 7, all 15 of them. And every second we have to check their risks. That if any of these positions are under margin, like what do we do? We liquidate the position, and if it is cross margin, then we have to kind of incrementally liquidate the entire book for that customer. So yes,
risk management.
Yes, risk management is very important, and that is where technology comes in.
There's lots of people at conferences I've met who have claiming to be building futures exchanges.
Yes.
No surprise. And I've noticed that some of these teams are just purely engineering. They have no financial background.
Yes.
And as people from finance, we always like to think that we're going to have something to do when we leave finance, and crypto has luckily provided that for us. But how important do you think it is or is it a necessity, or is it not a necessity for a new derivatives platform to have solid bench of financial experience? Or do you think it can be done without that?
Well, technically it could be done without that. You can learn what you don't know, but I think it's very important to have that.
So you add a lot of value.
I would like to think so. And I think just
if there's one thing that you think you bring to the team that, other than being the CEO, if there's one thing you bring to the team that you think is invaluable, like what does an ex-titan of finance bring to the future sort of fidelity of futures exchanges?
So I would say yes, the experience on the derivatives side and the quant finance side. Just in terms of product design, it becomes very important. And in terms of how do you build your risk systems, in terms of how do you build your trading engine, in terms of how do you build the product for the end customer, it all becomes pretty important. So it's imperative to have solid understanding of not just how these things are traded, but how these things are actually built and how they actually work.
Right.
We are working on our options part, and these things become even more complex because these are non-linear products. So if you don't get them right, there can be the last thing you want is design a financial product that creates an opportunity that has some flaw in it.
Yeah.
And in history there are examples where people have designed financial products with flaws in them, and people have exploited that. I think, or if something that should have been followed is not followed, and there's big repercussions for that. Bank of England and George Soros is a famous example of that. $1 billion in a day.
Oh yeah.
Yeah, precisely because the rates management from Bank of England side was poor.
Yeah.
So yeah, there is a lot of room to leave these kind of things, and whenever we build something, we want to make sure that it's foolproof, it's been vetted, and it's been it's closed all the loops, so that there's no such arbitrage opportunity which is on the product level. That your settlement should be correctly, it should be defined, and it should happen in a certain fashion. There should be no manipulation. There has to be convergence. All derivatives, they need to converge. That's how you ensure. If there is a theoretical convergence, then your price will not deviate away too much practically.
Yeah.
Because you can trade a future at any price you want, right? And how do you ensure convergence? Yes, there is margin requirement, but you can put a lot of margin and not get liquidated and take the price for a ride. But there needs to be something that is built in the product that makes sure that prices will be saner. We are very lucky to have
you.
That is handsome friends.
Yeah, the entire team is really good.
Yeah.
And then we have Professor Bhagwan Chaudhary, who was head of finance faculty at UCLA, and comes with a ton of experience in financial engineering, was at MIT as well. So yeah, every financial product that he's our advisor.
Yeah.
So every financial product that we build or have on the platform, we like to have a discussion with him first on those.
Yeah.
He's just a star and a big name in the financial engineering circuit, so it's good to have him review the products, all engineering products, financial engineering products that we are building.
So maybe just shifting gears slightly. So what is, India is kind of an interesting market. Like it's got 1.3 billion people. It's got a lot of people. It's got super smart, traders and people in finance, and a love for gold. But I feel like India's been a bit of a laggard versus other markets in terms of participation in crypto. I mean, you just don't hear about it as much.
I was just thinking about when you come into crypto, you often come at it from the idea, or you hear the people say, "Oh, we're going to bank the unbanked," right?
Yeah.
So there's the two most populous countries in the world, China, and then shortly behind is in India. So that's 2.6 going on 2.7 billion people on the planet, of which each of those countries must have hundreds of millions of people that are unbanked, and yet obviously the leaders of both those countries seem to be very against we as crypto community finding a solution for that. They'd rather find their own solution. Well, what do you think that's about? And then like Jesse said, like how do you think that's going to play out in India? Any feeling?
So in India, the concerns of central bank are mainly with regards to fiat and with regards to how fiat interacts with cryptos, and any possible imbalance in fiat in local and foreign currency that can potentially impact the exchange rate. So India is a loosely pegged currency, and if you have a flight of money of the local Indian rupee outside India, then it can create an imbalance which can kind of break pose a threat to the peg.
All right, yeah.
And peg is there because it's central bank's job to maintain a peg such that it's profitable for our economy.
Yeah.
So their concerns are legit and valid. And I think that is where they are coming from as well. Once they have more control over how to manage the fiat part of it, I don't think they don't want to stifle growth or inflation, growth or what do you say? Innovation, thanks.
Yeah.
So they are pro growth, they are pro innovation, they are pro blockchain. They've said multiple times that look, we want to promote this. They're still trying to find a solution, blockchain without Bitcoin. That doesn't seem to be working.
It's similar concerns in Taiwan. Obviously, that Taiwan is as a not very volatile currency.
Reason for that. There's a reason for that.
So obviously their concern is money coming into Taiwan, money leaving Taiwan, the same as India. But one of our pitches that we've done to regulators is that there's an opportunity here to build a financial system that's crypto, that's, Taiwan dollar neutral or whatever your domestic currency is neutral. So I just wonder why, is there any, have you felt that at all? Has that been discussed? Like, can we do like a, derivatives trading, options trading that's crypto? Like, how can you?
I think they are not very close to crypto. The idea of people trading cryptos to cryptos.
Yeah.
And even for that matter, cryptos to cash is what I believe they're okay with. It's basically the flight of money in the bigger order is what they're concerned with.
Yeah.
That you can take a chunk of money and just send out with Bitcoin, and they put checks and balances in the traditional banking system for that.
Yeah.
And those checks and balances can be broken here. So that's where they're coming from, and I think there are some very smart folks on the regulator side who are working on these things, and I'm very confident and positive that they'll build some solution where both these things can happen. They have their control over the flight of capital, and they also have enough room for crypto economy to grow, and for a common man or average Indian to access the crypto ecosystem. And that is what's going to be. That is what is going to make cryptos popular, and then you have a 1.3 billion diaspora that just opens up. So it's going to be very positive.
So we could probably do this all day, but I guess
we're going to get
if we do, no one's
people.
Well, the construction people are going to start throwing nail guns at it or firing nails from the nail guns.
We don't want that, do we?
Or people will they will go on too long. But we saved one of the most important questions to last, which is, so where's Bitcoin going to be by the end of the year?
So
can you make a big prediction?
So this big strategic discussion, and then it all comes down to, so what's the number?
Exactly. We have a dartboard upstairs. I can go grab if you need it.
So all that is great. What's the price?
Plug everything into your model, right? Where's your Bitcoin price at the bottom?
So I'm quite positive. I think the bear market is behind us, and I think we should definitely see new heights if by the end of this year or probably by first quarter next year. New all-time highs. And then probably look to consolidate around that level and then build for the next wave of blue oceans.
Wow.
Love it.
Exciting.
So maybe just let our viewers know how they can follow you and learn more about Delta and
Sure. It's very, and the site is delta.exchange. Very easy to remember, and then we have you can follow us on our Telegram community, on our Twitter. All the information is given on the website, our Twitter handle, Telegram handle, my personal handle.
So you have two Twitter handles, don't you?
Oh yes, we have one for Delta Exchange and one for Analytics Delta. Analytics Delta is our research, quant research arm. We publish a bunch of quant research things, more like arbitrages, premium discounts on futures, where is the futures market trading, what size of liquidations are happening, what is the interest rate market or the margin trading market telling us in terms of where the rates are, where the borrow is, how much is the borrowed amount. So we publish all this kind of numbers. We realized that there was no place where someone who's looking at derivatives market or who's looking at things from a more of a quant angle can go and just open one page and find everything at one place. So that's where we decided to build this dashboard or a portal where you have all this information. And it has information from, on the research side, we publish information from Delta Exchange, from BitMEX, from Deribit, from every good exchange, because look, you want a complete picture of the derivatives market. And so open interest of those, volumes of those, all that is available. We also publish research reports on statistical arbitrage, on comparing perpetual swaps versus futures for hedging, these kind of things, and it's all available on that place.
Good stuff.
Well, really appreciate you stopping by today, and
thank you. It's been a pleasure.
Definitely educating me, but also
I knew all of that stuff already.
But hopefully educating our users, and hopefully we'll get to India in the next few months and at some point and see what's going on down there.
We'll look forward to hosting you.
Thank you for taking your time out of your day.
Thanks a lot, Package.
Thanks.
Bye bye.
Cheers. Bye bye.